Hey, hey,
There we go.
how is everybody? I like multiple.
That's fine. Good morning.
Good morning.
Good Friday morning. Good fall morning here. Looks like our last hot day of the for a while up here in the upper Midwest. Supposed to be 95 today.
Oh,
Yeah,
wow.
Beautiful.
yeah, no humidity, so it's really nice. And it's supposed to get into the supposed to start raining this weekend and get into the 60s and 70s next week. So I think Sunday 65 is the high.
Oh, I think
Gotta love
it's
that
kind
too.
of fall weather. Yeah, I like it.
As long as it's not snowing, that's all I care.
Yeah. Um,
Hey Trent, before you
yes,
get
sir.
going, Mark,
Yeah.
I've got a question for you. Have you ever seen a chart where there was no resistance level specified? No resistance level specified on the chart.
Yeah, like the green line of death isn't there?
Yeah, right. The green line of death.
Yeah, it'll magically appear. I don't like trading on those charts because it magically appears and it always appears below where my price is. So I try not to do that. Paul does more of that than I do. But yeah, it just we saw a lot of that when the markets um, dumped and went up. Like a lot on that chart on especially on the upper resistance level because the markets were going up. It recalculated and didn't show it, and then all of a sudden, if you're in one of those positions the next morning when it recalculates, the line appears and your price action's above it, and then you see the market dump below it. So I kind of I stay away from those stocks. But I know
All
Paul
right.
Paul will run them up because he'll watch the Bollinger Bands, and as long as they're going up, Paul will run them, right, Paul?
Yeah, certainly I'll weigh in that resistance level, but with some of these, like good term used, momentum trading, it'll cut right through it if there's a lot of extra volume in that particular security. You might. I tend to be a little more aggressive. That's all.
That's true. Nothing wrong with that, but I stay away with it because I got burned on it too many times. So I just find I kind of I've always said it's kind of like flying you're playing without an altimeter. You know, you can look out the window and see where things are until you get in the clouds, and that's my altimeter. So I try not to fly on those stocks without that.
I got one last question I want to ask you, and this is on the Fidelity system. There are six different ways, I guess, and I know in your write-up you use stop loss orders.
Hmm.
Is there a reason why you use stop loss over stop limit, over the trailing stop loss, over the trailing stop limit?
No, it's just your personal preference. What do you use, Paul? You stop trailing stops, or you just use stops, or what do you do?
When I buy the security, like immediately right after I buy the security, I put a 3%. Depend how volatile it is, and it could be 3%, 4%. I look at the last wicks. I don't want to punk out,
Right,
just on a one wick,
makes sense.
right? So try to see the history. So it'll be either 3%. Usually it's like a 3% or actually 4% that I'll put a trailer immediately. And then, I'll look at it later. Um, and then kind of evaluate it. If it's starting to roll, I might pull the trigger and dump it. If it's trending higher, I mean, if the charts tell me, hey, this is an obvious strong resistance level and support level, I'll put the conditionals in. So the chart will tell me the plan, you know what I mean?
I try to put
Yeah.
mine about. I used to be 3%, but with the markets the way they are, I moved it up to two because I don't want any more loss than a 2%. And a lot of what I put on, paper trade portfolios up there, the volatility on a lot of those is just not. It's not like a Mag Seven stock or anything like that. You don't see too many of those, even though I have Google on there today. But I over time, you don't see me hop into those too very often. So it's kind of it's your risk management tool, Bob. How much risk do you want to take on the downside?
All right, this question is a stupid question, but I'm going to ask it anyways because
Well,
I've
there
been
are no
told in
stupid
life there's
questions.
no such
No
thing as a
stupid
stupid
questions.
That's
question.
right.
No, absolutely not.
All right, we're using percentages. I understand that. So in other words, I bought a stock for $100.
Okay.
I'm going to put a stop loss in if I use 2%, 98.
Okay.
Is that correct?
That would
You'd
be
let Fidelity,
2%.
yeah, you'd let Fidelity figure that out. So when you have the security and you hit the type of sell, you hit sell, and then you put the
Mhm.
type, and then there's percentage,
Yes,
stop
there
loss
is.
percentage. So you don't do the math, you just do type percentage loss, and then you put in 3%. And it'll put a trail on there.
It'll know that it's doing it on your costs.
That's right.
Yeah. On your cost.
It'll
Or
know that.
Well,
All right.
if it initially does it on your cost or whatever, it does it on whatever the stock is trading. So when you put that order in, if that stock happens to be up 1%, it's going to be 3% below that
Right.
current
So if
trading. Yeah,
your stock went up to $102, it would automatically move it up to 2 or 3% of the $102. So it's never going to go down though, Bob. It's always only going to go up, and if it comes down, it'll hit it.
All right. So the nomenclature, Paul, Mark, what you're talking about in order to have this go this way, is that stop loss or is that trailing stop loss?
Trailing stop loss is if you say
yeah,
I'll put it at 2% and it goes up, say from 100 to 102, it'll trail up. If it goes from 100
Right.
to 110, it'll trail up.
Right.
That way
Exactly.
you're
So
always
in
preserving
order
your
to
profit.
accomplish what you're just saying there, I should be using a trailing stop loss.
Yeah.
I could show you if you want.
I just want to make sure I've got the right nomenclature in the Fidelity system so that if it goes up to 102, 105, and I'm using 2%, if that was the high for the day, 105, it's automatically going to say, hey, this guy wants out 2% below. He's got to get
105.
out.
Yeah.
Yep.
That way you don't have to think about it.
No, you can go out and golf or do whatever you want. Go out and
Yeah.
polish your cars.
One other thing that I have found is if you look at the standard deviation of that stock. So, for instance, let's just say use NVIDIA as an example. NVIDIA standard deviation, say on a 3 to 5 day period, can move anywhere from a 0.5% to 3.5%. If you put your stop loss in at 2, you're within. You could easily get quickly stopped out, and that's the volatility of that position. But whereas if you said I'm going to put a stop loss on a bond like a 10-year treasury yield, that 2% is a big, you're not most likely to get stopped out. So just, I know, factor that into your thinking. How volatile is that individual position? And
Mm-mm.
could you put that stop loss in at 2, but it has a sort of a volatility range in an intraday of say 3, you're going to get stopped out pretty quick, potentially. So, not to make it more complicated, it's just one of those things that I have found that I could easily get stopped out of something that I shouldn't have been stopped out of. It's just moving around so much. Does that make sense?
All right. So the more volatile, let's say we were using this 2% that Mark brought up, but
Yeah.
it's a volatile stock. And I guess I don't know. You're taking a look at the wicks, I guess, in order to determine volatility.
Can I share a
Just,
screen?
Oh,
Yeah,
please
go
do.
ahead.
yeah. There you go. Go ahead.
I'm working on it. Share.
There you go.
Okay. So I bought Train this morning. Do you see this? Do you have a screen like this?
Yes,
Okay.
I do. Yes.
So when I bought Train, I said, I bought it based on fundamentals. I like the company and I like the chart. So I'm like, I like this stock. And plus, I didn't buy anything all day today, so I had to buy something.
You did. He
So,
is the machine. Paul is the machine.
soon as you buy it, this little S comes up. See the little S? Can
Yep.
you see that? All right.
Yeah.
Can you see it, Don?
Bob.
Or Bob, sorry, Bob.
yeah,
Soon as you see it.
I
right.
see it. By the way,
Right.
are you on Fidelity, Paul?
Yeah,
That's just
so there's
trading dashboard.
yeah, this is a
Yeah.
trading dashboard. Why you don't see this? You don't
Oh,
have
I
to
don't use Trading Dashboard. I use Active Trading, what, Pro,
Trader Pro.
Trader Pro. That's different
Yeah.
than Dashboard.
I'm
Yeah,
sure it
this
has the same options, but if you want to share, I
this
don't know. I never use it. Go ahead.
this is on the website. This is the Fidelity website, which is what I use also to put my orders in. I don't use Trading Pro to put my orders in.
Because
I just don't.
I like the visibility of this. I like the fact that it shows you the graph.
No, I like this. I mean, I
Yeah.
use these. I don't trade off of Active Trader Pro. I'll come over to this site.
Explain
Oh.
the S.
The what?
Paul. The S.
Yes.
You ever said the S. Explain finish
Okay,
what you're.
so this right here. So when if I'm going to go ahead and modify this, so I'm going to modify. Modify for me, yeah. So it says 8. So you see how this is about 2 wicks. This S right now is about 1, 2. You see this? You could if you drew a line from here to here, it would be one big long candle. Like it does get that volatile. Look at this candle over here.
Yeah.
So I know that this is about 4%. This is 4% because I have 4 in here. See the 4?
Yeah.
No.
That's
Where do
4.
you see 4?
Right here,
Over,
right there.
over in the
So,
order
I mean,
ticker
does the
on the
number
right side.
4 actually appear there?
Yeah, if I put 10, I'm going to put 10 in there. I could write whatever I want in here. What percentage you want? If I put 20,
Oh, I see. I'm sorry. You're these the camera's covering up. I'm only seeing half on my
Oh.
screen. The
Oh.
picture of all
you
of
mean you can move those pictures around, Bob. Just click on them and you can move our pictures to anywhere you want.
you.
let me know when you can see it. Can you see it?
Oh, now I can. I can't see
There
you,
you
but
go.
go ahead.
That's okay.
Okay.
So if I put 20, that's 20%. Oh, not 800. If I put 10%, I just made that. Oh, not
You put
no, not
that.
10%.
You put that in the quantity.
I know that's not good.
Go down to
So if I
trillium.
put 10%, right? Also good to know, not day, good till cancel.
Gotcha.
Good day. So, and this other stuff you don't have to worry about unless you want to start selling in pieces and stuff like that. This is based on the last. Make sure that's last. If I go preview order, tells me I could lose $300 on this
Yep.
based on what I got. I go place order. This whole now comes down here. Look at that's 10% away. See that?
Mhm.
Yep.
Now it'll punk out at 10%. If I go 2%, I could change it. And I say, you know what? I want 2%. It's going to go way up. 2% is way up here.
Yep.
Not bad. Because look I have good confidence that this is not a bad stop because it's to me, it's unlikely train's going to go past the 2 day. If it does, two last per days, 2 wicks, then something's wrong. Then I want to probably get the hell out. So
Well,
basically, I'm using these
following
candles.
it's following the
Yeah.
Bollinger Band up too. So if it pulls with inside that Bollinger Band, you might see the green line of death come out.
Yeah.
So
if we were to look
basically,
at the
you're
other chart,
calculating your deviation range based off 2 days of wick movement in this
For this-
scenario.
For this scenario, I'm throwing that up. But actually, I like train a lot, so I'll probably go in. I had 3%. I prefer 3% because I'm like, based on train itself.
Yeah.
So in
I like
in this scenario, you could have had $373 of loss, is what you're saying.
that's right.
Yep.
That's right.
Which is good because you know your loss up front and you're accepting it. If that happens, you accept it, you know?
Right. And
As opposed to having a disaster happen, let's say an earthquake hit the train factory, the main train factory, and wiped them out, you know, and the stock went down, you know, 15%, you're out, you know, that's your peace of mind. And you said, man, I got out and I'm happy with 373.58 as my loss.
right. And the train would have to happen while I was away from the trading desk. So
Right.
I would have to be leaving to go cut the grass, go take my mom grocery shop and go record music, whatever. And then, if I come back and it punked out at 3%, I'm okay with that. I'm
Right. And
not,
that's why
yeah,
I like it. You don't have to sit here and do that if you don't want to,
Oh,
you
yeah,
know.
I agree.
that's right.
Yeah.
Right.
Yeah.
So I would
Um,
play around with it a little bit, Bob, and see how it works. Don't go extravagant into it, and just get used to it
Yeah, I
and how it
understand.
works.
Thank
I
you.
think
Thank you,
the
gentlemen.
more you like, if you took the more you focus on a stock and learn its behavior patterns, you can better apply that trailing stop uh, application and be more accurate,
yeah,
Yeah.
kind of
like you were
thing.
saying, NVIDIA, you put NVIDIA here, look at this thing. It's trading at 116, right? So if I had stock, I might say, I'll punk out maybe down here because something really has to go wrong. So the
We
candles
don't see
give
your
me a good
screen.
idea. Oh, you don't? Okay, that's okay. All right,
Yeah.
that's okay.
But
I'm
yeah,
glad.
but I think
Yeah,
volatility on an underlying stock can tell you a lot about how it's going to move intraday.
Hmm.
And you can, if you're like 3% is what all I want to max, max loss, you apply that. But take into account that you could have pretty volatile, get stopped out before you really should have been stopped out based on the volatility of it. It gets
It
complicated,
does
but just
it
I would say start with one thing and just learn it and work it, kind of
Gotcha.
thing.
I totally
it comes
agree.
it comes back to how much risk do you want to take, how much risk on the downside you want to take. You know,
Yeah.
if if you look at a stock that maybe your risk level is 2% and the volatility shows that it's at 5%, and you don't want to lose 5%, you don't want to take that chance because maybe 5% is $1,000, that
Yeah.
you may not want to be in that stock, or you set it at 2%, says so be it if it hits 2%, knowing that the volatility is a higher probability it might hit than something that's at 3% or 1% or whatever.
Have you ever seen a case, and I guess I'm going to say in a case of a market crash where it couldn't honor your 2% and it went below, it went greater than
Well,
2% and
it
cash you
depends.
out.
It depends if you do a trailing, or if you do a limit, stop limit, it'll trigger you at that limit. But if you do a loss, it could change it to a market order, and you might not. If it goes really fast, you might not get the price you want on some of those
So there is that possibility of that happening
on really
It's
fast trades. Yeah,
using the trailing stop loss percentage.
I think it's
you
rare.
have.
But you
it's
think it's
It,
probably
rare.
I
Yeah,
think
it
we
doesn't.
I saw it more during the great financial crisis where
Right, everything's going
news
down.
came out, market opened up and it gapped down, and that's when those kind of things happen. But I think
That's
during regular day trading,
All right.
like we've been in, you don't see as many of those big gaps,
Mhm.
kind of thing.
yeah,
That's
I would
really,
agree.
and I think that's where you take your environment that you're in to where, okay, is there a possibility some news will come out over the weekend that would be really damaging and the market opens down, 5% at open, you'd then, yeah. But I don't know if we're there yet. You'll
no,
know.
if you have a low volume stock, you can get nailed too.
Yeah.
Yeah,
Well,
yeah.
Their
You
bid
want
and
you
ask are
want
so wide.
they
and
are.
that's
That's
why
why
you
I
set the volume parameter on this. What was it? More than 500,000 shares per day.
that's what I like. Yeah, at least minimum.
All
Hey,
right.
Mark.
Thank you, gentlemen. There was a cloud there, and I was taking a look at that. It's an odd thing, though, on Fidelity, though. Uh, in order to see support and resistance, you would think that that would be an ordinary thing, but I literally have to hit a particular dot on a line in order to open up a box where it says modify.
Mm-hmm.
Have you ever seen that?
Yeah,
Modify?
yeah.
And then
Because
it'll show support and resistance levels.
well, you put it on, and you can modify it either long term, short term, or intermediate term. And I always use the intermediate resistance level.
Yes, yes. Yeah,
Are you saving your screen? And that's your default. Because if you close the screen and don't save it, then you have to reset everything again.
Right.
oh,
When you
all
close
right.
it, you hit that little X up at the top. It'll ask you if you want to save your settings, and you hit yes. Unless you've screwed up your screen somehow, you don't want to save it, and you don't hit yes.
I know
I've
if
done
you
that.
want,
I've done that a few times.
oh,
Yeah.
it generally says if you got the chart on the screen and you're going to leave, you say I'm leaving, it'll say, are you sure you want to save this or not?
You
And
shouldn't manually have to put in your stops every time you pull up a ticker. So if you put up a ticker, that stops, the button should be on and those stops should appear.
hmm,
If you're
So
manually having to, go ahead.
here's the cues. Okay. Here's your resistance. Here's your support. If you click on that, there's your modify.
yes,
And right here, mine's on intermediate.
yes,
Okay. You can move it to long, didn't do anything. You can move it to short, didn't do anything on this particular cues. Okay. So if you set a chart up like this, you can go up to this box right here, click
yes,
on it. If it will work. Come on.
hmm,
There. And you come down, you go save chart.
yes. I
And
understand that.
and then you put in what it is, QQQ.
Yep,
Make sure you make this my default chart and hit save. It'll ask, okay, you already have this saved. Do you want to replace it? Yes, I do. Okay. And that'll save it for you.
I have there's another issue, and I know you folks say, Bob, you've brought up 3 issues already. You said there's no more. And I wasn't going to bring this up. I'm sorry, I can't display this. I don't know how to display this chart to you. But on it doesn't matter, whatever chart of whatever security, I'll have 6 lines show up. I'd like to get rid of all these lines. I don't know where they came from. And it's
Well,
not just support and resistance.
you can
There's
come up
other
here.
lines.
If you've placed them in here, like here's the 200 day,
Yeah,
which is this line here.
yeah.
If you go up there and you click on that, you can delete it. So if one of those lines is up here on your menu,
All
you can
right.
get rid of it just by clicking on it. You
Gotcha.
can modify it, you can delete it, you know.
All right. All right. Well,
It's
I'll play around with that.
yeah, and these are not dumb questions, Bob. These are the right questions, you know, because you want to understand it, you want to get it right, and that's what we're here for.
Yeah.
And
Thank you.
we got a good group of people who've been doing this for a while, and they know what they're doing. So,
Hey, Mark,
yeah,
I got a question for you. When you talk about your green line of death,
yeah.
what is that exactly, and how are you setting that up?
Green line of death. Here we go. My favorite indicator. So here's the green line of death. And
Okay, what is that? Is that just something you put at the top of the Bollinger Band, or
no, that's a program puts it in. It's a resistance level,
okay?
and it comes with the support level. And let's change this. Let's change it to Berkshire. Oh, I forgot Berkshire don't have it. Let's do NVIDIA. Oh, that doesn't even show it either.
How
Oh yeah,
about
it does.
SPI? How about SPY?
Okay, SPY. It's somewhere we can see it. Yeah. Hold on.
There's no green line of death. It's blue line of happiness.
The blue line of happiness. That one's too close. Let's go to Murphy. Murphy oil. Okay, yeah, because this is one that's on the watch list. So I always put in a line when it goes on the watch list so I can see where my cost basis is. So I put this on there myself. And I can take it off, I can remove, I can do whatever I want with it. When I go in, and this is where the sell orders are, okay? And to find those, you go up here to technical analysis and hit this button. You can take your stops off, and that takes that blue line off where the sell orders are, where the stops are. And here's support and resistance. That takes off your support and your resistance, or puts it on.
That's pretty trick.
Is that Did you see what I did?
Yes, no, I see
So
what you did.
it's a resistance line that the software is actually finding
Right. And
based
so what,
on
yep. And then it's based on
History.
their history and their calculations. You can go inside by modifying it. You can make it short term. Oops, short term, which moved it. You see it move
yeah.
on this stock? Intermediate term or long term. The long term only moved the support level. You see that? Watch this blue line right here. When I hit intermediate, that moved it. I always use intermediate term. Okay. So in the intermediate term, it'll even tell you right here, Bob was talking, here's your resistance and here's your support level. And then you just click on, and if it's like by itself, you can see it's blue. Yeah, here you can see it's purple with like the line, and here it's green, you can see. And this to me is one of my favorites. If it gets up there, I get out, no doubt about it. I'm out. Okay. So other people may want to trade a little closer to it, but you'll see a lot of times, see this 9 swing up and it'll get really close and you'll start seeing sideways trading on this. And then it just gets squeezed out and I'll see it go down. I'd say 80% of the time at least. And that's just my thought. I didn't go calculate it, but that's what it feels like to me. So did that answer your question, Eric?
Yeah, I get it. It's software based. I didn't realize that.
Yeah, it is. And I like it because it does it on its own. I don't have to do it. And it's
It
pretty
takes the
accurate.
thinking
Look
out
at
of it.
this. Look at this. Look at the support level here. I mean, this is as accurate for me as the resistance. This is the intermediate support level. Look at Murphy oil. Came down, boom, hit it for 3 days. Okay. Bollinger kept going down, started showing some signs, got above the 9. One candle above the 9. That's why I got in, even though it's under the 200. I said it was a riskier one. It's oil. It's going to be more volatile. Okay. Um, and here we are today. So this one, for me in the paper trade portfolio, I'll probably get out of this before the weekend because I just don't know what's going to go. And oil is always so touchy. If you got a profit, take it out and go to dinner like Paul does. So
Hey, Mark,
yeah,
I think you made a comment on this resistance line, the green line of death.
yep.
If you see where the current stock price is up there pretty close, is there a parameter that you say, hey, it's not worthwhile trading? Everything else being equal. I mean, your RSI, your MACD, your SS, they all are where they should be. You're above the 9-day. You've had one full candlestick above the 9-day, but you're up very close to the level of resistance. Is there a variance that you observe that you would not trade given all the specifications I just
Yeah,
said?
if it was close to that line,
Yes, sir.
then you look at risk and reward. My risk, let's say that this candle was right here.
That's right.
So
Exactly.
for me, my reward is this much. And let's say that the next line of support is down here. Let's say this is our next line of support. My candle's here. This is your reward as far as I'm concerned, and this is your risk.
Gotcha.
So no, I wouldn't get into that. For me and my risk profile, I would not get into that if it's by this line. Now, from my history of doing this, what gets it past that line? Well, maybe the Fed comes out and drops, your rate by 50 basis points instead of 25, and then your price action can actually get above that, back test it, and then it automatically will calculate it above it. And I've had that before, but unless there's some kind of market condition to push that price beyond here, you might see it go up. And a lot of times, you'll see the where the stops are put, to get out. And this one I need to push up, above, tight. Yep. Will be up here, and you'll see it go up and hit those stops and then come back down below. So, I don't mess with the green line of death. That's why I call it the green line of death. I just don't mess with it.
Hey,
Okay.
Mark,
I got
you have
a
issued
lot of
that
room.
statement so many times that it is fully emblazed in my head. The line of death. I automatically think of that. Man, and when
Yep.
I hear that death word, I
Yep.
jump, I go in the opposite direction.
So down here, I've called this the blue line of hope, but then I didn't know if that was good enough. So we started calling it the blue line of happiness. Okay, because if it bounces off that, you're more happy. But either one. What do you guys want to call it? The blue line of hope or happiness?
About life.
No hope. Hope's not a strategy.
Yeah, that's true. And
It's
happiness.
Yeah.
happiness.
Life.
Okay.
Oh.
Okay. So that's what we'll call that. The blue line of happiness. It's like the bluebird of happiness. Okay. Shall I get on to our rant today?
Yes.
Yeah, please.
No. So we did a video yesterday, Trent and I, we talked about the Fed. And I'm going to do a variation of that because I don't know if you guys watched, the FOMC press conference when Powell came out, and I called it the Federal Reserve clown show. Okay, because they raised they lowered the basis by 50 basis points, which is really kind of unheard of, for a first cut, if everything's okay. Okay. Um, so the Federal Reserve cut its benchmark interest rate by a half percentage point. That was Wednesday. And that was the first rate reduction in over 4 years. We've been waiting for this for a long time. Why it matters to me, or the stock market, I don't know. The stock market's been on a run ever since they've been raising rates. The average rate is somewhere between 4 and 5% anyway, historically, on what the Fed rate is. And the Fed rate is just the rate that they charge banks for overnight deposits. Okay, so it really doesn't have much to do on the long end. It's just on the short end, and it follows the 2-year yield. That's what they do. They follow the 2-year yield. The 2-year yield was at 3.6%. So it was about the Fed rate was about 200 basis points behind that curve of the 2-year yield. So they voted 11-1 to reduce the federal funds rate to a range of 4.75 to 5. It was 5.25, 5.5, and that was maintained at its highest level in 2 decades for over a year. Okay. So they assured it, and if you watch Powell, he assured there was not an emergency response, even though it was 50 basis point, and unveiled projections that analysts say reflect conditions for the economy to achieve a Goldilocks scenario where growth is steady and inflation and unemployment stay low. The last time the Fed cut by half a basis point was in October 8, 2008, 3 weeks after the collapse of the investment bank Lehman Brothers. Okay. So they have this dot plot, and people they go nuts over this dot plot, and it's where the Fed governors put the dot in the future where they think the rates are going to be. Okay, so in June, just a couple months ago, only 4 FOMC members expected no rate cuts. Okay, in 2024, 7 members said 1 rate cut for this year, and 8 members said 2. Well, 2 days ago, only 2 members had priced in 2 rate cuts by year end. 7 saw more than 3 rate cuts. 8 saw 4 rate cuts by the end of this year, and 1 had 5 rate cuts. So we went from hardly any rate cuts to maybe 1 to up to 5, and something changed. And what changed is, the unemployment and the jobs reports came out, and you saw the unemployment tick up, and that spooked him. You can tell when he was out at the Tetons, Jackson Hole, that they didn't want unemployment to get out of control. And this half a point lowering tells me that they're scared that it is out of control. But Powell said, the U.S. economy is in a good place, and our decision today is designed to keep it there. Okay. And I'm thinking, well, if everything's so good, why do we need to change in the first place? Okay. And if we need to change, why do we need to change by 50 basis points? So he went on to say, recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, okay? And investment in equipment and intangibles has picked up from its anemic pace last year. He said in the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year, which was really strange because yesterday the existing home sales were reported, and the existing home sales fell by 2.5% from the previous month to mark the fourth decline of the year. The decline took place despite the drop in mortgage rates in the period, which contributed to a drop in the median existing home sales price by about $10,200. Inventory of unsold housing rose and edged higher to the equivalent of 3.9 months of sales at the latest rate, and that was picking up from 3.6 months, okay, of being on the market. So there's more houses out there, there's more on the market, and the home sales are falling. Okay, they're not picking up, even though that's what he said. So there's strike one of something he talked about. Trent can verify this because he lives in a neighborhood with a lot of homes for sale, and they're not moving down there in Florida along the 30A corridor. Second thing he talked about was growth in the GDP, and the real gross domestic product in the U.S. grew at an annual rate of 3% in the second quarter of 2024, up from 2.8% in the initial estimate and 1.4% in the first quarter. The upward revision was mainly due to increased consumer spending. Okay, increase what they spend on. Well, in services and goods. Within services, the leading contributor to what people spend on were healthcare, housing, and utilities. Well, that's not like going out and taking a vacation or buying a second house. That's just living your life. That's, inflation. Within the goods, the leading contributors to the increase were gasoline and other energy goods. So you had, energy goods to heat your house, air condition your house, drive your car, drive your truck. So I'm not seeing that the growth in the GDP was anything about going out and getting things you want, but more like getting things you need. So although the GDP growth in Q2 hit an annualized rate of 3%, a sharp increase from the modest 1.4% in Q1, many economists predict that it could slow to around 0.6% in Q3, as high prices and high interest rates put a squeeze on consumer spending, which is contracting what Powell is talking about in his press release. So strike two, okay, we've got housing, we've got growth. And then he talked about inflation. He said inflation has eased notably over the past 2 years. Okay, well, the rate of inflation has eased, not inflation itself. He never says that, but remains above our long-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that, excluding the volatile food and energy categories, because we don't use those, core PCE rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in the broad range of surveys of household, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median project is 2%. So they're saying they're going to hit their 2%. Okay. So being the inquiring mind that I am, I didn't have to go back too far. If you remember last week, the CPI came out and they used the core CPI number. Core inflation, which strips out food and energy, because we don't use food and energy, obviously, advanced by 0.3% on a monthly basis, above the 0.2 predicted. Year over year, core CPI remained elevated at 3.2%, well above the Fed's 2% target. Producer price index, okay, the cost that producers have that pass on to us consumers, which exclude food and energy, okay, rose by 0.3% a month in March compared with a forecast of a 0.2% increase. So what we're seeing in reality is that the core CPI and PPI have leveled off and are starting to dip up or move up a bit. And so my fear is that by cutting interest rates so quickly and going back to history, that we're going to see inflation pick up. And we've seen this in the past, that inflation has picked up. And I can show you a chart here. Let me share this. And this goes back to the Arthur Burns days. And this is the green line is back in the Arthur Burns days of inflation. Okay, and what Arthur Burns did is when inflation got down to this point, he started cutting rates before he should. And what happened to inflation? inflation went back up because he cut too soon. The red line is where we are today. Okay, this is under Powell, and he's cutting rates right here. So it'll be interesting to see if these charts follow each other. But if history tells us anything, and he cut too soon, and the fact that he cut by 50 basis points to stop the unemployment rate from going up, while inflation is still in CPI and PPI turning up, gives you a chance we might see this same kind of chart. But just keep that in mind, and we'll see what happens. But that's the history of it. Okay. So continuing on. Again, we talk about inflation, and he says it's under control, or he's getting it under control. And then a recent study by savings.com showed that nearly 80% of US adults have cut back on groceries due to rising prices, with 37% reporting they're extremely or very concerned about their ability to afford enough food. And even more people are worried about the affordability of healthy foods. Okay. So again, I'm going to call that strike 3 on inflation, housing, and growth. The fourth thing we're going to look at are jobs. Okay. Powell said, overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic of 2019. The labor market is not a source of elevated inflationary pressures. The median projection for unemployment rate is 4.4% at the end of the year. That's 4.2% now, so it's going up. Okay, so 4/10 higher than projected in June. So in June, it was 4% was the projection. Now it's 4.4%. So he's saying that it's under control, but he's still projecting that it's going to go up by another couple tenths of a percent. So the Bureau of Labor Statistics, when we talk about them, admitted that its downward payroll revisions 2 weeks ago, a couple weeks ago, the monthly increases in jobs in the past year was not 230 a month, but they revised it down by a total 818,000 jobs that were never there. So that rang down, that brought the monthly gain of 230 down to 150 a month. Okay. So that's actually down 31.2% off the headline numbers. So how are jobs getting better or under control when we're eliminating jobs right off the report? And then what about full-time workers? When we look at that, in the last non-farm payroll report, according to the BLS, while the number of employed workers did rise by 168,000, it consisted of an increase of 527,000 part-time jobs, offset by 438,000 in a plunge in full-time jobs. So full-time went down by 438, part-time went up by 527,000. This means that since last June, the U.S. has added just over 2 million part-time jobs and lost over 1.5 million full-time jobs. So he may be looking at reports and saying, yeah, the jobs are doing all right. We're adding, but what are the quality of those jobs? Part-time jobs, they don't offer benefits, and they don't, and they pay far less. Okay. And so if I lose my job and I was making $100,000 a year, now I've got to find a job and I can't find it. So I'm taking part-time jobs. I may have to take 3 or 4 part-time jobs to make $100,000 a year. And we're seeing that too. So people with more than one job has jumped above 8.5 million now, and that's back to all-time highs. So more people in this country have more than one job, part-time job, as compared to before all this inflation started. So Powell also stated, again, in these jobs, I've said that jobs is going to be the third leg of the stool, stated that during the presser, they've not seen any significant company layoffs. And it was just blowing me away because Challenger Gray and Christmas just came out and said U.S. employers announced 75,891,000 job cuts in August of 2024, the most in 5 months, and the most for the month since 2009, when excluding the pandemic-induced crash of 2020. Okay, so we're seeing that it's a record high of monthly job cuts, but he's not seen it. Just today, entertainment and record label company Warner Music Group said it plans to reduce its workforce by 750 employees, representing 13% of its total headcount. More than 10% was expected earlier. Smartphone chipset giant Qualcomm announced it'll lay off 226,000 employees in San Diego later this year. Cisco is cutting 842 jobs in the Bay Area. Boeing announced it'll be temporarily furloughing a large number of white-collar employees. This news comes after 30,000 Boeing workers began a strike on Friday after rejecting a new pay contract. Okay, And this doesn't even include the strike that's going on the East Coast at the ports. Volkswagen is considering axing as many 30,000 jobs as it scrambles to save billions of euros amid a slowdown in the car market, German media reported. So I don't know where he's not seen it, but I guess he's too busy to notice these job cuts. But we go over them every week. Okay, these are not small job cuts. So on jobs, I give him an F too. So there's 4 strikes out of, his speech saying that everything's okay. I'm just looking at his reports that the government put out. Let's just go a little further. How's the consumer doing? Okay, so consumer credit. July consumer credit soared more than 25 billion to a new record high of $5.093 trillion. When you look at the components, the spike in revolving credit, okay, and that's credit card debt, grew by 10.6 billion, the biggest monthly increase since February and the second biggest of the year. So we're spending more on credit. We're on our credit limits. And what about our savings? Well, consumers were ever more strapped for actual cash and equity as the personal savings rate in the U.S. moved down from 5% to 2.9%, the lowest since the Lehman bankruptcy. And in just 1 year, as all the excess savings from COVID are long gone. Okay, and we can look at a chart of this also. And let me get the right one. Well, yeah, where'd it go? Too many charts to show you guys. Where did it go? Well, not being able to find it, so we'll just have to trust me on that one. So savings is down, and credit card debt is up. Okay, people are using credit to buy things that they need, not that they want, and they've gone through their savings. So the consumer is not looking good on a credit rating. But this week, retail sales are up. Okay, so that was the big news this week. It was reported with much fanfare that retail sales in the U.S. edged up 0.1% month over month in August, following an upwardly revised 1.1% surge in July and beating the forecast of a 0.2% decline, signaling, according to the talking heads, consumer spending remains relatively strong. However, and unfortunately, retail sales data is not adjusted for inflation, okay, which includes mostly goods. So if you adjust for inflation, retail sales are flat year over year. Okay, so what that's telling me is that retail sales are up because of inflation. So you're buying less of what you're buying. And I made the example yesterday. Instead of 2 bags of groceries for $100, you get 1 bag of groceries for $110 now. So inflation has brought it up, and that's what you're seeing in retail sales. So the reality is consumers are feeling the pinch of higher inflation, and this is now being reported by the banks. Ally Bank came out, and their CFO was warning about weaker credit and net interest income trends quarter to date relative to expectations. Specifically, he said that in July and August, they saw auto delinquency soar a whopping 20 basis points compared to their expectations. Over the course of the quarter, our credit challenges have intensified, Hutchinson said. This is their vice president, Ally Bank. Our borrower is struggling with high inflation and cost of living, and now, more recently, a weakening employment picture. He also said that the firm may experience some underperformance, adding that Ally will evaluate reserves to cover bad loans and increase them if needed. Total credit card debt is at all-time high, while personal savings rate is at all-time low. So again, is the consumer resilient? I don't think so. Okay, according to the Fed and what I saw at the clown show, consumers spending like they were. Consumers resilient. Jobs are plentiful. Housing's doing great. We're seeing good growth. What about companies? What are they doing? Are they doing great? Are they showing better than average returns? Mercedes-Benz said yesterday its 2024 earnings before interest and taxes will likely come in significantly below the previous year, citing a further deterioration in the macroeconomic environment, mainly in China. The automaker also said it expects its adjusted return on sales between 7.5% and 8.5%, down from their forecast of 10 to 11%. Last night, FedEx shares slumped on Friday after the parcel giant cut its annual revenue forecast and reported a sharp fall in profits owing to weak demand for high-margin speedy delivery services. FedEx, which is seen as a bellwether for worldwide economic trade, attributed the fall in its profits to waning demand for priority shipments between businesses as customers try to curb expenses. Okay, so that doesn't sound good that companies are doing all that well. Bankruptcies. Okay, U.S. bankruptcy filings spiked in August after a slowdown in July, propelling the total for the first 8 months of the year to the highest level since 2020 and the second highest since 2010. Since 2010. That's S&P Global Market Intelligence. Manufacturing. Yeah, ISM manufacturing PMI a couple weeks ago edged higher to 47.2, still in contraction from the November 23 low of 46.8 in the previous month, missing market expectations of 47.5 and reflecting the 21st monthly contraction in U.S. factory activity in the last 22 periods. The result extended the weak momentum for manufacturing in the U.S. economy, underscoring the impact of elevated interest rates by the Federal Reserve in the sector. Employment levels fell for the third straight month in manufacturing. On the price front, costs rose at a faster pace, inflation, firmly above market expectations that expected a slowdown to 52.5, which would have been expansion in manufacturing. We don't have it. And that challenges the Fed's hope of deflation in the economy. So we have employment down, we got prices up. How about the budget deficit? The U.S. government posted a $380 billion budget deficit in August. This is where we're getting some of our growth. We're spending so much money. All those treasury bills we used to get at 5.5% are now below, 5%. They're in the 4%. We're spending money. So we're at a $350 billion shortfall. It was the widest budget gap since September 2022 as outlays jumped 254%. What we're spending jumped 254% to a near 1.5 year high of 6.87 billion. For the first 11 months of 2024 fiscal year, the U.S. deficit has increased by 24% to 1.897 trillion from 1.525 trillion in the same period of fiscal 2023, as the current year's interest costs on public debt top 1 trillion for the first time. The World Economic Forum President Borge Brande has raised alarms about global debt nearing historic highs, warning of a potential decade of low growth and the risk of stagflation in advanced economies. So if the U.S. economy is in such a good place, going over what I just went over, why did the Fed feel it needed to raise rates by 50 basis points or even cut at all? Well, it's because they know too many recession alarms are going off, including the yield curve just uninverted, the SAM rule just got hit, and we have history. Now, what does history tell us? The last two times they cut rates by more than 50 basis points, the economy fell into recession a few months later. The first time was January 3rd, 2001. The result, over the next 448 days, the S&P 500 dropped nearly 39%, and unemployment jumped by 2.1%. The recession that followed was tied to the dot-com bubble bursting and was made worse by September 11th attacks. Then on September 18th, again, 2007, they did it again, another 50 basis point cut, and the S&P plunged by 54% in the following 372 days. Unemployment surged by 5.3%. The recession lasted until mid-2009, made worse by the housing market collapse and a global financial crisis. So the Fed's goal to achieve a soft landing might be harder than they think. Comparing the current economic indicators with those of 2001 and 2007 would add to my concerns. Okay. In 2024, our federal funds rate was between 4.75 and 5%. Before the 2001 recession, it was at 6.5%. Okay. Before the 2007 recession, it was at 5.25%. Unemployment's now at 4.3%. It was 4% in 2001 and 4.6% in 2007. So history shows that rate cuts of this size have always led to a recession. If the Fed manages to avoid one, that'll be the first time ever. Okay. So by the Fed cutting rates by 50 basis points, they're trying to avert more economic or more unemployment, rising unemployment. We saw in the last two times that the Fed did this, unemployment rose right after they did it, and the markets tanked. So they're trying to focus not on the inflation side, but now on the employment side, without really having solved inflation yet. We're seeing the CPIs. We'll keep watching them monthly. They're starting to turn and head back up. Were they going to do it? I don't know. History says probably so. So just keep that in mind that what the Fed did on Wednesday and saying that 50 basis points just to, nothing big. I think it is something big. Okay. And we go back to history and we see what they've done. Okay. And we see what the result is. So just be very careful. Now, that doesn't mean we can't go swing trade. We're swing trading right now. We've got open positions and you guys have open positions. And that's the beauty of swing trading because it gets you out before a bigger issue happens. That's why we were talking about stop losses, Bob, to make sure that if something happens, you're out at the level you want to be out, at the loss you want to be at, and you don't end up, falling in one of these traps that we're seeing being set up right now, I believe. So that's my rant, guys. And I know Trent probably has some follow-up comments on that, and then we'll open it up to what you guys think. Trent?
So there's two negatives and then one opportunity. So let me share my screen here with you all. Let me know when you can see this.
There it is.
Okay. So this first U.S. hires total non-farm payroll. This chart depicts over the last 3 years, going back to September 21, the total hiring that's going on, percentage change since September 21 to was it July of this year, 24, is down 16.9%. So the number when we hear these job numbers, we hear layoff, he mentioned something about he's not seeing layoffs. Look at it, the hiring side of this. We're not hiring, which means eventually we're going to start laying people off. If you're not hiring, you're not growing, you're not expanding. So when he said that, I started looking at it going, what's the true element? I mean, if we're having an economy that's stable and is growing, you're hiring people, correct? I mean, anybody who owns a business or works for a business, when you have growth, you hire people. This year alone, we're down 4.6% in hiring. So we're on a negative downward trend when it comes to that. On a 3-year basis, it's 16.9. And then on a 5-year basis, it's down 7.41%. So the last really 3 years, we have seen an acceleration in the decline of US hiring. Is the consumer still good? Well, US consumers with new bankruptcies has increased 17.5% year to date. If I look at a yearly chart, it's up 14.63%. So fourth quarter of last year, we started to see an increase of US consumer bankruptcies. These are people who can't cover their debt anymore. They're underwater. We're seeing an acceleration in that. And to me, that is concerning. That's the consumer has no more credit. They're maxed out. They're not making money to offset that credit or to pay down that debt. And so they're screaming. If you look at U.S. consumer credit card account delinquencies by 90 days or more, it's up in the last 12 months, 15.91%, which contributes to this part over here. So the consumer is not strong. And since we're a consumer-based nation, we have to take that into account. So on the positive side, let me show you one other thing here. On the positive side, so when the Fed starts lowering rates or aggressively like they are, historically, it affects the value of the US dollar. So if I go back to the week of March 2nd, 2020, the US dollar, we entered the pandemic and they started lowering rates pretty aggressively. Up until was it January of this is the US dollar. So the US dollar started to lose value and declined from the week of March 2nd, 2020, to where it bottomed in the week of January 4th, 2021. Well, what went up? What investment category went up? If you look at emerging markets, this is EEM. This is the ETF for emerging markets. March 2nd, 2020, EEM went down to closed out the month at 34.13. The next month, April, it started moving higher. Now, remember, the dollar chart was going south during this period of time. Emerging markets started to rise. And when the dollar, hit support back in February, the week of February 1st, 2021, emerging markets hit its peak at $53.73. That's a pretty substantial jump overall, roughly $20 per share on EEM. Here we are today. This is a monthly chart. This is the month of September so far. We've started to see emerging market EEM start to rise again, starting back, I would say, March of this year. If I go back and look at, if I can actually see it, hold on, I'll go back and look at the dollar. This is US dollar. We go back to March of this year. That's March 1st, the week of March 1st, or the month of March. We peaked out in April and we started to see the devaluation of the dollar. And so we're seeing this opposite correlation happen with emerging market. EEM is the ETF, and the US dollar. As we see a continuation of interest rate cuts, which they're expecting to, I believe, cut another 50 basis points by year's end, we will see a continuation of a devaluation of the US dollar. And if history repeats itself, emerging market, in particular the EEM, is an easy way to play it, is going to rise. So as you're starting to look for, and this could be more on an intermediate term to long-term investment perspective, as that dollar devalues, the US dollar devalues, emerging markets is going to start going up. And so rebalancing or reallocating a portion to emerging markets could be a big benefit to your overall portfolio. Along with, if you can find emerging market stocks that could benefit from a devaluing US dollar, that could also be a swing, more of a longer, more an intermediate term swing trade kind of a opportunity. So it's when you start to look at how our US dollar and the decisions our Federal Reserve is making by making these lower interest rates, and they're talking about their target is 3.5% by December of next year of 2025. Imagine where the US dollar will be, and most likely will be down around 98, 98 cents in 2021. It got as low as 90 cents on the dollar. So your opportunity could be more overseas in emerging markets from a more intermediate to long-term basis. So as long as they continue to be aggressive about lowering rates, which I think they will, because the acceleration of the decline of our economic status in our country, you're going to see an opportunity overseas more so than in the US.
I
So
just looked
that's
up,
my take. That's the opportunity, I believe.
I just looked up EEM, and one of its top three holdings is Kroger. And Kroger's a
Really?
good, yeah, KR. And I looked, it's TWHK and Kroger. I know Kroger, and Kroger's trading, Kroger's pretty defensive stock. So I'd go right for some of these stocks that are in that ETF. That's my
Yeah.
2 cents.
Yeah.
And
I
this is
think
not,
though, I think we're going to see though, you talked about, they may continue to lower these rates in an aggressive manner to try to bring unemployment down, which is going to fail. But I think on the other side, I really do think that inflation is going to keep going up and they're going to have to start raising rates. They're going to be in that quagmire, and right now they're just trying to get us to the election, without anything happening, I think. And if they have to start raising rates again, that's going to be crushing. Okay,
Yeah.
because I don't think they've really solved inflation yet. But and if they have, then they
No.
have to worry about stagflation.
Well, I
Well,
think
this is true. Hey guys, this
Hi,
is
Bob.
Bob,
Welcome,
fuel on
Bob.
the
We haven't seen
fire.
you forever.
I'm sorry, I had some medical issues.
Oh, I hope you're okay.
Yeah, I'm recovering, but I'm going in for surgery next month.
Oh no.
But yeah, I got a heart issue going on, so
uh-oh.
I'm gonna get it rectified next month.
Okay.
Sorry, I missed
No.
the show, but I'm getting back into things, and I think that this was just, I mean, my first question is, do you think the Fed cut was political? I would say partially.
Yeah.
I would say being on the business side, business sucks. So there isn't another word for it other than you get into profanity about it. But um, business is bad. I think it's bad across the board with everybody. Everybody's starting to feel the pinch, and I think the Fed went too far. They waited too long to
Yeah.
cut rates, and now housing is not even recovering. So when you push housing down like this, that's a problem. Then you get into the housing part. Let's just say, well, rates are going up for housing. They're not going down. This is not the long term, rate that they cut for
Right.
for the mortgage rates. But if you get into housing, housing covers a lot of categories, and it's not. This is not going to stimulate it. They're going to have to do something on the long term rates to get that to happen. Um, so that's dead. And none of that, but Mark, as you were talking about debt, people don't have the money to put down. The average person or the middle class is struggling to have money to put down on a house or a car. Um, like I told you months ago, they'll give a loan to a mouse. That's the statement because they know no one has any money. The M2 money is zero. So I think the markets, um, I just think that this is like, off the cuff rate cut. And I was surprised at 50, to be very honest with you. I thought they're going to go 25. But now they're talking about even being more aggressive with another 50 to back it up in a very short term, in a timeline. I think the market is just going to run and it's going to be turbulent. We're going to see the VIX jumping, and which makes opportunity. But I think our economy is in trouble. That's my consensus of it. People they're not hiring. My business is horrible, and I sell the nuts and bolts. So if they're not buying that, they're not building things. And you brought up about the port. My friend across the street from me, he works at the port, and they are going on strike because they want a 70% increase. Yeah,
So
70%.
does everybody
So,
else.
so here, I'll tell you a little short story because he's on the inside. So they gave, I think, $100 million in bonuses last year, but the owner took $4 billion bonus. That's how profitable the shipping industry is. Okay.
Wow.
And all the guys, the merchant marines that they want a piece of that, right? So they
Sure.
want a 70%, not of that, but they're starting to introduce robotics at the ports, and that's the big item on their list. They do not want any automation that is going to uh, have union workers, because they're all union, lose their jobs, and that's the big nut on the sheet of paper, or the napkin per se. But
How I guess, well, people don't think beyond what
they
their
make a lot
boss
of
got
money.
paid.
They make a lot of
Yeah.
money. They don't make a lot of money on their base pay, but their overtime more than doubles their pay for the year.
I mean,
Right.
think about it, just not even the economics of pay. Just think about the strike and how long a strike would last and how, again, our supply chain is going to be, you're going to have cargo
Interrupted.
ships sitting out there waiting to be
My boats
unloaded.
are not going to be coming in,
Right.
from
And Christmas
overseas.
is coming up. Got the
That's
holiday
right.
coming up.
And they know what they're doing. They're going to
Yeah.
disrupt the markets. And
Yeah.
and then what's happening is going to happen. All these ships are shipping out, and they're just going to be backed up in the water, sitting in ports, 100 miles off the coast. I mean, it's going to be a disaster. He says they're going on strike, and I would take what he says as, a pretty good piece of information.
Boeing's on strike. It looks like Stellantis is on strike. Ford looks like they may be going on strike. I mean, that's just adding more fuel to the economic flame that we're talking about.
It just
Yeah.
drags everything down, Mark. I mean, it
Yeah.
just makes everything worse. And I said to him, I said, well, does the unions cover any of your time out? And absolutely not. That's, can you file for unemployment? Yeah, we can file for unemployment, but that's a cup of coffee for me.
Yeah.
You
And
know
most of those people don't have the savings to back it up to take that
Yes.
much time.
The
exactly.
savings is depleted. Yeah.
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 Yeah. I honestly, I was, Mark and I have talked about this whole presidential thing, and I'm like, more and more I hear stories like you just shared with me, Bob. I don't know if I'd want to be president of the United States right going
Yeah,
into
but
the
he's going to be
next
taking
4 years.
over.
Huh?
Yeah, I know. I know. He's going to be taking over a pile of shit to deal with, right?
Yeah. Yeah. And that's the thing is people don't look at the data. They're not looking at the data.
Yeah.
They're
Yeah.
just looking at personalities.
Listen, we all know it. Taking that position brings you wealth, right?
Yeah.
And in many different ways. When you exit, there's a lot of wealth to gain, and that's really the
True.
bottom line.
Yeah,
Um,
that applies.
besides
That applies.
all the corruption.
That applies to Congress and the Senate and all
Yeah,
that too.
all of them, absolutely.
Yeah.
They come
I
in
mean,
broke and they walk out millionaires.
Yeah. If you can
yeah,
get
you
them
don't
out.
You don't
Right.
go into
Well, they
politics
usually die in the
to
chair.
change the world. You go in to get rich.
Yeah,
Yeah.
exactly. And they usually die in their chair, so they don't uncover any secrets.
Crazy. What you got, Bob?
I've got a question, and this is the correlation. We see a devaluation of the U.S. dollar, emerging markets will go up. What I
Yeah.
don't understand, if the dollar is going down, and Mark has explained all the stuff and you've explained with the charts what's going on with the U.S. consumer, and now you got a weak dollar. How do you buy foreign goods? How do you buy foreign goods in emerging markets? These are third world countries, the way I look at it. They're not first world countries. So, they got to be really cheap. They got to be extremely cheap. And then, of course, the
Yeah.
American doesn't have any money. So how could is this a different thing? Is this different this time around?
That's a good question. Is it different that I remember hearing Joe Kernan say that in 1999, but I don't, I don't, I look at it from the perspective of history and why does emerging markets go up? Well, possibly because um, the money that is here in the United States that has been going up, pushing technology and AI stuff higher, has to find a place to go. And right now, emerging markets and historically that correlation of devaluing our dollar, fuels emerging markets. And understand emerging markets includes China as well. So you see money flowing to value opportunities, and on a country basis, emerging markets is one of those areas. And what history tells me, and what just looking at the charts, they're oppositely correlated. The opportunity in the next probably year is probably going to be as long as they're continue to be aggressive about devaluing the dollar, is going to be an opportunity in emerging markets. Is it a quick trade? No, but is it something that you could, crank out, you know, 50+% returns on over the next 12 to 18 months? And historically, it has. So something to take a look at.
It's
We
What I
also
interesting
don't
have a
because
new
understand is why
I
is
went
alliance.
over
Kroger in there? Huh?
We
I went
also
over
have a new
last week. I
alliance
went over
going
last
on with the
week,
BRIC nations.
but I went over last week. The Chinese are shorting our dollar right now, which
Our
will be
dollar?
interesting. Yep, I went over
Yeah.
that last week. The
Yeah, yeah.
Chinese are, so it'll be interesting to see how that all plays out too.
Yeah. I think we by devaluing our dollar it's really weakening our situation. I was thinking about I'm going to dinner with some friends tonight, and you know, I'm losing what today I'll lose. Well, we'll just look at yesterday. How much buying power did I lose yesterday? I lost point 30 basis points in buying power. If I look at it from a weekly standpoint, last week I lost, I didn't lose as much, but the week of August 19th, I lost, 1.68% of buying power. Well, you start linking those together, it's going to get more and more expensive to go out to
Well,
eat. It's
we'll
also
throw
going to
inflation.
and then you include inflation on top of it, and
Yep.
you squeeze everything. So where's the cheapest produced products in the world? Vietnam, Indonesia, Malaysia, China. That's emerging markets. That's potential where Wall Street or money is
Prob-
going to eventually flow.
Problem is that if you look at the world economy, China's in the dumps, Germany's in the
Hmm.
dumps. Okay, so this is just as a United States thing going on. All these
Yeah.
countries are extended on their deficits, government spending. Uh, the Chinese real estate is crap right now. Their manufacturing's crap right now. You saw what's happening in Germany in Volkswagen and Mercedes Benz, and you know it's it's just bad. They're pretty much in recession in Germany already, and that's the heart of European manufacturing right there. So
Does
again, this
anybody
isn't
know?
just this just isn't us. It's
Yeah.
everybody.
Does anybody
But
know what
again,
the India ETF is? Because if you look at India, that's their 50. I don't think that's it. It's increasing value. Um,
INDE is
so
one.
what is it?
INDE is one ETF for India. But the volume is crap on that one, so I wouldn't even look at that
Yeah.
one.
Um, but anyways, you start to look at some of these other emerging market countries like India and Malaysia, and these countries are actually are doing well. So it's something to keep an eye on, especially from a more intermediate to long-term perspective as we continue to devalue our currency. Money's going to flow elsewhere, and opportunities are going to be created. So,
But what about reserve currencies? Reserve currency in the United States has been a reserve currency, and we're losing that status by the coalition of BRIC nations.
sure.
So what does that mean to the value of the
It'll
US
be
dollar? Or
it'll
is
be
that why we're devaluing?
we're
Because nobody
devaluing
wants the US
because
dollar.
we're
They want
devaluing
the
be,
BRIC.
we're devaluing because we're spending more, we're printing more money through the treasury. Uh, it's like a stock that goes out and has you know an offering for more shares. If I double the amount of shares in my company to bring more money in, you as a shareholder have just been devalued. It's the same thing. Anyone who holds a dollar, every time they print more dollars, you hold a dollar, supply and demand, your dollar goes down. Okay. On top of it, purchase that. So your purchasing power is down, but it costs more to go buy things because inflation. So you're screwed in two directions with what's happening right now. And then costs more to buy things. You get less for the money you have, and the money's already devalued. Your savings rate is down, so you go to your credit card, and that's what we've been seeing. And this whole thing, every time I hear Janet Yellen or Powell or Steve Leisman talk about the consumer being resilient, he's certainly not living in the world that I live in or the world that I'm looking at. Okay. And that I have to actually go dust off, my poor economics degree from a Big Ten land grant university from 20, 40 years ago and say, I don't see it. Unless economics has changed over 40 years, I don't see it, you know.
Yeah.
I think we got to remember that the market is not the economy.
No, I
Because
agree.
we've been, constantly saying, yeah, that correction's coming for a long time. But while we're saying it, you got Meta hitting all-time highs. You got Google hitting all-time highs. There's parts of the market that, we keep on talking like that. We don't get in. And what I'm saying is, I'm just trying to make a distinction. We could sit here
Yeah.
and
No,
say all
I'm
the,
just,
but we spend a lot of time making arguments why it's bad and the
well,
market's not. You know what I'm saying? We're kind of on one side. We should look
well,
at both sides.
So I think,
Paul, I always come back and say that's why we swing trade, and I said it a couple times in this Zoom call that's why we swing trade. We can get in, we can get out. That's why I like it in the type of
Mhm.
markets we have. I guess the reason that I do it, and I say this, is because there might be people in here who haven't gone through what I've gone through. Going back to 87 was my first crash. And I see the patterns and I see what happens. And you're right. I say all the time, the market is not the economy. And it's not. However, history shows that the market is going to catch up with the economy, or the economy is going to catch up with the market at some point. We cannot sustain what we're doing right now forever. And a lot of the people that have gotten into this market have gotten in during the pandemic, and all they know is buy the dip. Okay. And that kind of situation, if they're not aware of what I'm trying to explain here, they're going to end up just like in 2008, wiped out, uh, because they're going to get pulled in by the institutions. They're going to rug pull them. They're going to lose their money. And I don't want to be the one that said, I told you so. So I agree. But I think that we need to be more cautious. I would rather have it be, the pandemic time where everything went up. You didn't have to make any money, just like .com. You didn't have to make any money in .com. Just put .com behind your company, and you became millionaires. People say that people quit their jobs. They became day traders. They went into margin, and then they ruined their lives when the whole rug got pulled. So that's what I don't want to see that anymore, because I had to hear those voices, Paul, back in the .com and back in the great financial crisis, of the people who got caught up in the hype, didn't know what they were doing, and then lost everything. And it's sad because it doesn't have to be that way. It doesn't have to be that way. So, but I hear what you're saying. But I agree. That's why we swing trade. I mean, I've got over 200, almost 300 paper trade portfolio trades since the beginning of the year. So it's not like we're stopping, you know.
Right.
But I'm
Right.
cautious.
Again,
But
I think,
I appreciate you saying that, because it can be taken that we're being negative. I'm not trying to be negative. I'm trying to be factual. So, but I
I think the
appreciate what
one,
you're saying, Paul.
Mhm.
I was
I think
one of
one,
those,
one,
Mark. I was one of
What's
those
that?
guys calling you saying, "What happened to all my money?"
Won't be calling me.
Not anymore, but I
Well,
was one of them.
yeah.
I think,
Those are the punishments, that you take.
I mean,
And
I would go down and listen to the margin calls when we were making margin calls in our margin department, and just the desperation and the hopelessness and the voices of these people who didn't know what they were doing, went out on margin because everything goes up. They were all, geniuses.
it
And then
also goes down.
when it fell down, they lost their houses, they lost their accounts, they lost their cars, they lost everything. They signed the margin agreement.
yeah,
It was over. And those
I
people
think,
didn't come back. They didn't come back to the market until the pandemic. That's when you
I,
saw retail people come back in.
I think one thing to take from this, Mark's rants, my rants, is to also, and we should back it up with, where's the opportunity? Where is the cycle? Where are we cycling to? Because there are four cycles. It's like seasons. You got winter, spring, summer, and fall. And right now we're in fall economically. We're starting to slow. It's getting cold, and it is accelerating. So where's the opportunity? If they're devaluing the U.S. dollar by lowering interest rates, where's the opportunity? My concern, and I've seen it, and as a financial advisor for 21 years, was people get stuck in one silo and they don't deviate. They don't look at the environment. They don't look outside of just the S&P 500. And I think it's very important, especially now with technology, you're able to look at what are the ingredients that causes the economic seasons to change. And right now you're seeing it. And I think it creates incredible opportunity. I promise you, January of 2026, there will be some guy on the front cover of Forbes, and they'll say he made $50 billion take home pay because he studied the charts, he studied the economy, and he saw the opportunity, and he leveraged up and he bought in and he made billions of dollars. While everybody else is like, what are you talking about? When did that happen? How did that happen? And I think that's, my personal mission is to say, listen, it's not all going to be, rainbows and puppy dogs, but there is opportunity to capitalize on it. Swing trading is one opportunity. Economic rotation. Where is the money going to flow? Emerging markets. If we do this, therefore this happens. But if this happens, therefore this happens. I think it's important to think. Think how is Visa going to be the car company to own over the next 12 months? If delinquency rates are skyrocketing, if credit is, if they're shrinking their availability of credit, is Visa going to go up in value? I would say no. They're not going to get the prime rate their interest rates they used to because prime rate is adjusting. Is the a Visa a place to go? Or would you be rather go into a bond index or something that's going to go up in value over that time? And then this is a game of rotation, in my
Yeah,
opinion.
yeah. Here's Visa right here. See, you can make money. This is during the whole time we're talking about where you got to be cautious. Visa came up, green line of death, popped above it. Today, Visa is now under a 9. This is where if I were in this and got in, if you'd used my trading guidelines, you'd probably have got in right about at this point. You'd be out today because you're underneath that. You're going to close under the 9. I would have got out at the green line of death, so I'd be at the same level, but you'd be out. So again, here's something that Paul's talked about. Paul's brought up Visa and Mastercard, and they did. They had a nice run. Now I think it's going to be over. Why do I think it's going to be over? Because the MACD crossed, the stochastic crossed, and that usually tells me the high probability we're seeing this histogram go down. That Visa is probably done for a while. Take your profits. Let's go out and find the next one, Paul.
Oh, I didn't make
I mean,
money from Visa. I made money from MasterCard.
Okay, same thing.
Yeah, yeah, no, no. I'm just
so
But what I'm
apply.
saying,
So
what I'm saying is,
yeah.
you're right, Paul. There are opportunities out there. They're not as easy to find, and that's my job is to help find those every week, and we'll have them out there. Just you got to be more careful because we're not in, the go everything up market. You really got to be a good trader. You got to be you got to know what you're doing, but there's money to be made. Like Trent just said, money flows to where the value is, and there's always what's Kramer always say. There's always a bull market somewhere. Well, may
Well,
not be a bull market, but there's always areas where you're going to see money flow to. They're harder to find. They're tougher to maintain in your portfolio. You got to really be tight on them, but you can do it if you want to put the time in, like you guys are doing. Like you guys are doing.
yeah,
yeah, I mean, you made a good point. Where I don't know, it
I,
was a month ago when there was plenty of opportunities that we took advantage of, and it was much more easy to find those charts where now
Yeah.
it's not so. Now
No.
it's like slim pickets, and you find myself forcing, but you can't force it. You got to wait till
Right.
that market comes to you.
Yeah. I always say
And
let the
yeah,
market come
yeah,
to you. When in doubt,
Yeah.
sit it out. You know, it's your money.
Yeah.
Why lose it? Why put it out there? You know,
And I
when
would
you
say
don't have
stay
to.
nimble
Yeah,
too. Stay nimble.
absolutely.
Yeah, you
And
got it.
and
Yeah.
it's whatever your risk tolerance is. You know, mine. I don't like losing money. I don't like gambling. I don't. I look at odds and probabilities based on the charts and say, okay, does the chart, like I said this week in the Discord, you know, my trading plan is my wingman. Okay, so if I have doubt, I go to my wingman and I blame it on my wingman. My trading plan says don't do it. I'm not going to do it. You know, but that's my trading
Yeah.
plan. Everyone has their own and their risk tolerance.
I think that's a key takeaway from this channel is to have a trading plan,
Absolutely. Or an
right? Because
investment plan. Yep.
yeah, something that tells you, it gives you an exit position.
Keep your emotion out of it. Do not
Yeah.
fall in love with the stock, you know, because it doesn't care for you. Don't fall in love with an industry. Doesn't care for you. Okay. If you're all into one industry, like, you know, technology, you know, and when technology falls, you fall with it. And you got to know when to get out, you know when to hold them, know when to fold them. And that's what these charts tell us, whether you're an investor or you're a trader. That's what these charts tell us. And Paul, you
Yeah.
say it all the time. You say it all the time, and I agree with it. You know, I let the charts tell me what to do, you know?
Yeah, absolutely. I wish Dave was on. I was proud of him because he was, as we know, he's buried into the tech sector, but he started branching out into other sectors by using the charts. So
Yep.
I like that he's using the chart for
Yep.
entry. He's formulating his own exit plan. But I tell you, it's hard not to fall in love with GEV. But I bought and sold it like 3 times already, and it's treating me well. But
Yeah.
you got
You're
to
making
keep the
money.
emotions out of it. You got to keep your emotions out of it, because
Yeah,
there's yeah.
well, Trent
What do you
said
say?
he said it right. He says there's being right or there's making money. Which one do you want to be?
Yeah,
You know, and there's nothing more true than that. I mean,
that's true.
uh,
That's true.
David and I, we had a discussion earlier this week about Berkshire, and his chart said Berkshire is going to take off. Right, here's Friday, and we were talking Tuesday, which is here. And I said, well, not according to my charts. I said, because I don't have confirmation on this on the MACD yet. And even though it's above the 9, I still don't have confirmation. And look what's happening today. It's coming back. It's moving sideways. I need I need to use every dial on my instrument board to fly this plane. And when one, especially, this is my fuel gauge. When one is this bad and it hasn't crossed yet, I'm not gonna make the trade. I'm not gonna take this plane off yet, even though you're seeing that it's above the 9. This means a lot to me right here. So I haven't got into Berkshire. And you guys know I love Berkshire. You know, I'll trade in and out of it and invest it every day. I mean, if I had one stock to do, that's what I would do, you know, and it's just not the time yet. And it's for the last 4 days, it hasn't been the time, you know, but it will. Eventually it will, and we'll be fine. But it's not
Yeah,
today.
I think like my point is like you say, there are opportunities. Like Google, I had gotten to earlier, and I got out of it, and it was a good trade. Um, and you like, but then you look at the charts. Maybe I should stay in a bit longer, but it's not looking good right now. But there's so
Mm-mm.
many stocks out there to choose from, and then you lay off it. The market's not coming to you.
Right.
But don't. I think it wouldn't be bad to be like I'm in train now. It's not. There's stocks out there that have a good narrative too. They're a good story. We mix that in with the chart, makes for a good trade. Apple's doing phenomenal now.
I gotta
So that,
go.
oh, you're taking off,
See you
Bob?
guys.
Take it off. Bob,
Let's
it's
see you
good to
next
see you
week.
again.
I
And I
hope your
hope
health.
hope things work out, and I hope you're back next week. And you
I'll be
know,
there next week. I'm not going into October 8th. So
okay.
um yeah. Anyway, everybody have a great weekend. I'll see you next week.
You too.
You
Thanks
too,
for your
Bob.
input,
Take
Bob.
care.
Appreciate it.
Bye.
I think we got to wrap it up here.
Yeah, we've been doing good. Anyway, I appreciate all you guys. I appreciate all your comments. I appreciate all your questions. I appreciate everyone participating and answering those questions. I don't mean to be negative. I just mean to say, look, what I see on, I try not to watch CNBC and the financial because they're all trying to sell you up. Okay. And it's even the Fed. And I watched that and I'm like, people actually believe this. Well, they're getting their data from these reports. Well, what do these reports actually say when you get past the headline? Well, they're not all rosy like they say. And so I just want everyone to be aware. Don't get caught up in the hype. Think on your own. Look at the charts. Utilize the charts as your wingman. Get your own system. Become comfortable with it. Don't fall in love with a stock or an industry. Let the market come to you. And when in doubt, sit it out. There's always another day, right, Paul? You miss today, you go tomorrow. You know,
That's
and
for
that's
sure.
what I don't want anyone to lose money, and I don't want anyone to have a catastrophic loss. That's why I'm on this channel. That's why I'm here with Trent. And if I can save you from doing that, I'll be a lot happier than if I made you 10%. If I saved you from losing 50%. Anyway,
Real quick question. So he lowered rates 50 basis points. When does that show up?
12 to 18 months.
So that's why the Fed funds rate hasn't budged. The effective Fed fund rate hasn't budged from 5.33%.
Well,
look at this.
Everyone's like, look at the mortgage rates. They're going to go down. Mortgage rates are going to go up because they follow the 10-year. Is the 10-year up today or is it down? I haven't looked. The 10-year treasury yield.
It's up 0.40%.
So
yeah,
you missed it, Trent. You missed it, Trent. That market went up within 24 hours. You should have sold. You missed it. If we're talking market.
What, the stock market?
We're talking treasuries. We're talking treasuries.
Yeah. Oh, I thought he says when does the 50 basis point make a difference and when does it affect? You just missed it.
No, when does the actual rate show? So like when I pull up the
Fed on the
funds,
website,
effective funds rate, it still sits at 5.33%.
Oh.
So it has not changed.
No, I don't know when they do that.
Yeah. So I don't know if it's, I don't know if, like you said, does it filter in the system over the next 6 to 9 months? Just like when they raised them.
See, I thought you were telling me when does that rate cut affect the economy? That's what I answered on that.
No, okay. I just want to see it change on the chart, and it's not changing. So, right. Which tells me everybody's all hyped about this. To actually get that to budge, they're going to have to lower rates even more aggressively,
which is going to cause more inflation.
Yeah, crazy. All right, guys. Yep. I appreciate y'all. Thank you so much.
Thank you very much. I appreciate it.
Thanks, Bob, and thanks, Paul. Thanks, everyone. We'll see you guys at 3 maybe, and have a good weekend if we don't. Hopefully I'll have another list by Sunday night that you can peruse through and see if there's anything that's interest for your swing trades. All right?
Thank you. That'd be great.
Thank you.
All right, guys.
See y'all.
Have a good weekend.
Bye-bye now. You too. Have a good weekend.